What if I told you there's a company, one you've likely never even heard of, but it controls critical parts on, well, nearly every plane in the sky? We're talking commercial jets, military aircraft, the works. And get this, it can charge almost anything it wants for them.
It's quite the setup.
Exactly. So today we're doing a deep dive into TransDigm Group, ticker symbol TDG.
Yeah, we've pulled together a whole stack of material, in-depth analyses, financial reports, even some pretty pointed congressional testimonies about this aerospace company. It's fascinating stuff.
Absolutely. Our mission today, for you listening, is to really unpack its unique business model. We want to understand these sort of fortress-like competitive advantages they have.
Explore its financial muscle, too, which is impressive.
Definitely. And then weigh the risks and maybe figure out what's next for them. The goal is you'll walk away with a much clearer picture of why TransDigm is so remarkable and, frankly, so controversial.
Controversial is definitely part of the story here.
Okay, so let's dive right in. This business model, it gets called a masterclass in value capture, sometimes that razor and blade system. What does that actually mean when we talk about TransDigm?
Right. It's actually quite elegant in a way. Think of it in two stages.
Okay.
Stage one, let's call it the razor. This is where TransDigm designs and sells these highly engineered proprietary aerospace parts. They sell them to the big guys, the OEMs, original equipment manufacturers like Boeing and Airbus.
For the brand new planes coming off the line.
Exactly. And that initial sale is absolutely critical because once their part is designed into that plane, it secures its position on that aircraft platform for its entire life. Decades, potentially.
Okay, so that's the razor locked in. What about the blades?
Ah, yes. Stage two, the blades. This is where the real magic happens, financially speaking. Those critical parts, they don't last forever. They wear out over the aircraft's lifespan, which is typically, 25, maybe 30 years.
Maintenance, repairs.
Precisely. Maintenance, repair, and overhaul MRO. TransDigm provides the replacement parts for that MRO work and this aftermarket business. It's incredibly lucrative. It accounts for over 75% of their profits.
75%?
Yeah.
Wow. Even if it's a smaller chunk of total sales.
Yeah, exactly. It's all about the margins on those aftermarket parts. If you look at, say, fiscal year 2024, their pro forma revenues were roughly 32% commercial aftermarket, 28% commercial OEM, that's the initial sale, and about 40% defense.
So it's diversified, but heavily tilted towards that profitable aftermarket.
Correct. And that gives them this incredibly stable, recurring revenue stream. It's sort of insulated from the usual ups and downs, the cycles of new aircraft production.
That blades part, it sounds less like just selling parts and more like a compounding machine. Those big cash flows from the high-margin aftermarket, they're not just piling up in a bank account, are they?
Oh, definitely not. That's what's really fascinating. It's not static at all. It's dynamic. Well, those predictable, hefty cash flows are systematically reinvested. Primarily, they use them to acquire other niche aerospace companies.
Oh, okay. Buying up competitors. Or related businesses.
Usually related businesses. Each acquisition brings its own set of proprietary, often sole-source products, and, crucially, its own aftermarket potential.
I see. So each company they buy adds more razors.
Exactly, which then generate more high-margin blade revenue down the line. It creates this powerful, self-reinforcing flywheel effect.
It's a flywheel. I like that. Keep feeding the machine.
And it works. This strategy has fueled just incredible growth. We're talking revenue and EBITDA growth north of 20% annualized, going all the way back to 1993.
20% annualized since 93. That's a stunning longevity for that kind of growth. So what makes this strategy so enduring? It sounds almost simple on the surface, but clearly it's incredibly effective.
Well, there are a few powerful forces working in their favor. First, the aircraft themselves. They last a very, very long time.
Right, those 25, 30-year lifespans you mentioned.
Yeah, and the platform itself might be produced for 20 or 30 years before that. So you could have a TransDigm part on a platform that generates revenue for over 50 years.
50 years, okay, that's a long runway.
A very long runway. Second, you've got the fundamental growth in global air travel. The aftermarket business is tied directly to flight hours and the size of the global fleet.
Driven by people wanting to fly more.
Exactly. Global revenue passenger kilometers, or RPKs. Historically, they've grown about 5-6% annually, basically doubling every 15 years or so, going back to 1970. It's this fundamental human desire for travel providing a huge long-term tailwind.
Makes sense. Travel keeps growing, planes keep flying, parts keep wearing out.
And the third factor, which is absolutely crucial, is safety-driven demand inelasticity.
Inelasticity, meaning price doesn't affect demand much.
Precisely. Safety is everything in aviation. Think about the cost of having an aircraft grounded in an AOG situation. You're losing tens, maybe hundreds of thousands of dollars per hour, lost revenue, angry passengers, logistical nightmares, damage to your reputation.
Yeah, okay, that's a disaster for an airline.
Right. So the cost of that grounded plane vastly outweighs the cost of a replacement part, even if that part seems expensive in isolation. When a critical component fails, the airline needs a certified, reliable replacement immediately. Period.
No shopping around.
No shopping around. This creates incredibly inelastic demand, and that allows TransDigm to command premium prices.
Okay, that paints a really clear picture of their pricing power. This leads right into their competitive advantage, their economic moat. How would you describe this fortress TransDigm has built?
It's a really potent mix. Primarily, it comes down to two things: intangible assets and high customer switching costs.
Let's break those down. Intangible assets first.
Okay. So over 90% of TransDigm's revenue comes from proprietary products they own the rights to. And for about 80% of their sales, they are the sole source provider. Nobody else makes that specific certified part.
How do they achieve that? Patents.
Patents help, sure. Intellectual property protection is part of it. But arguably, the even bigger piece is the FAA certification process. It's incredibly rigorous, time-consuming, and expensive.
Right, the Federal Aviation Administration. They have to approve every little thing that goes on a plane.
Every little thing. So imagine you're a potential competitor. You'd first have to somehow reverse engineer TransDigm's part without infringing on their IP, which is hard enough. Then you'd have to navigate the FAA approval maze. We're talking potentially years and huge costs.
And TransDigm already has how many approved parts?
They have over 300,000 active parts manufacturer approvals, PMAs. The sheer scale is staggering. Someone trying to estimate the cost to replicate that portfolio, it came out over $22.5 billion. It's just not economically feasible for anyone to try.
$22 billion. Wow. Okay, so the intangibles are massive. How does that lock customers in, those switching costs you mentioned?
They're directly linked. Once a TransDigm part is designed into the plane's original specs and it gets that crucial FAA certification, it essentially becomes the only option. It's the standard for that specific application on that aircraft model.
So if an airline wanted to use a different supplier's part, even if one existed,
they'd face a mountain of hurdles. First, the risk. Is this new part truly as reliable? But more tangibly, the expense and time of getting that new part certified by the FAA for use on that specific aircraft. That process alone can take up to 18 months.
18 months.
Yep. And cost maybe $75,000 to $100,000 per part.
For a part that might only cost a few $1,000s itself.
Exactly. The switching costs are simply prohibitive. Why would an airline go through all that hassle, expense, and delay for a relatively minor component? They wouldn't. So they're effectively locked into TransDigm's ecosystem for the entire life of that aircraft.
This is where it gets really fascinating, isn't it? Let's make this concrete. Paint us that picture, that real-world scenario. The aircraft on ground, AOG.
Okay. Imagine an airline. One of their planes is stuck on the tarmac. It can't fly. Why? A small but critical hydraulic valve has failed.
Okay.
This valve is a proprietary sole source component made by one of TransDigm's subsidiaries. Now, let's say it cost TransDigm maybe $150 to actually manufacture this valve.
Oh.
But last year, they sold it to the airline for $1,000. This year, maybe feeling the market, they've decided to raise the price to $2,000.
Double the price. So what does the airline do? They're losing money every minute that plane sits there.
They're in a terrible bind. Every hour is costing them, like we said, potentially hundreds of thousands of dollars. There is no other FAA-certified valve they can just swap in.
No.
None. Try and get someone else to make one. That would take years and cost a fortune in development and certification. So what's the rational decision?
They pay the $2,000. Easily.
They pay the $2,000, get the part, get the plane fixed, get that multi-million-dollar asset back in the air generating revenue, that extra $1,000 price increase. In the context of the AOG cost, it's basically a rounding error.
Yeah. That's just incredible pricing power. And it highlights that inverse relationship, right? The cheaper the part is relative to the cost of the whole aircraft or the cost of downtime.
The stronger TransDigm's position.
Yeah.
Exactly. It makes absolutely zero financial sense for a competitor to spend, say, $100,000 and wait 18 months to get certified to sell a $1,000 part with a limited total market size.
While for the airline, even 100% price hike on that $1,000 part is noise level compared to their overall operating budget for a $100 million jet.
Precisely. It demonstrates just extraordinary pricing power.
So this moat, it sounds pretty unbreachable. Is it stable, or is it actually changing over time, getting stronger, weaker?
It's not just stable. All the evidence suggests the moat is actively widening.
Widening? How?
The primary driver is that relentless, highly disciplined acquisition strategy we talked about, that M&A flywheel.
Right, buying up more companies.
Yes. Since their IPO back in 2006, they've snapped up over 49 businesses, and they're still going. Each acquisition is carefully chosen. It has to be a manufacturer of proprietary sole-source parts with significant aftermarket revenue.
Adding more little monopolies to the big one.
Exactly. They're not just buying revenue, they're bolting on new miniature fortresses to their existing one. Each deal expands their portfolio of locked-in, high-margin revenue streams. You can see it in the numbers. They've basically quadrupled their market share in the last decade, from about 1.1% to 4.5%.
Wow. Okay, quadruple market share. So with that kind of power, customers locked in.
Yeah.
How do the customers actually feel about this? Is there any love lost there, or is it purely necessity?
Yeah, love is definitely not the word. Customer sentiment is, frankly, built on necessity. They're captive.
You hear that from investors, too.
Oh, yeah. Investors discussing the model openly talk about how OEMs like Boeing just have to bite the bullet on even 100% price increases for small parts. They have no real alternative.
And what about the government? The military buys a lot of these parts, too, right?
They do. And the U.S. Department of Defense, the DoD, has been perhaps the most vocal critic. There have been multiple reports from the DoD Inspector General, congressional hearings, all accusing TransDigm of egregious price gouging and earning excessive profits.
Egregious price gouging. Strong words.
Very strong. They've cited specific examples with markups allegedly as high as 9,400% on relatively simple components. U.S. senators have written letters directly to CEO Kevin Stein, demanding refunds and blasting the company for refusing to provide detailed cost and pricing data.
Ouch. So, huge criticism from a massive customer.
But here's the paradox. This really negative sentiment, especially from powerful customers like the Pentagon, it's arguably the strongest confirmation you could ask for of just how strong that moat is.
How so?
Well, think about it. If the DoD, with all its purchasing power, all its political clout, cannot force TransDigm to significantly change its pricing practices or provide the cost data they want, what chance does a commercial airline have?
Good point. If the Pentagon can't strong-arm them.
It means TransDigm is, for those specific parts, indispensable. And ultimately, they get paid. The complaints actually validate the business model's power.
Fascinating paradox.
Yeah.
Okay, that's the external view. Customers aren't thrilled, but they pay. What about internally? What's the culture like for the employees inside TransDigm? Does that contribute?
Yeah, looking at employee sentiment gives you a more positive, though still kind of nuanced picture. Data from places like employee review platforms suggests the culture is definitely demanding, intense even, but also engaging and mission-driven. Employees tend to rate their teams very highly, like A-grade, top 10% of similar companies. They seem to take real pride in the fact that they make mission-critical parts, things that absolutely have to work. The overall environment is generally described as positive.
Okay, so demanding but rewarding, maybe.
Seems like it. But the intensity is real. The pace is often described as extremely fast, and about a quarter of employees report working more than 12 hours a day.
Wow, 25% working over 12 hours.
Yeah.
That's intense.
It is, and it ties into their operating philosophy, which really comes from the company's private equity origins. It's all about decentralized leadership. Business unit managers are expected to act like owners, take responsibility, manage their P&L, make measured risks.
High accountability.
Very high accountability. It's a high-performance, results-oriented environment. And that seems to be a key ingredient in their overall success. They execute really well.
So who's steering this ship? Who are the architects running this compounding machine? And what's their core philosophy on managing it all, especially the capital?
The leadership has been remarkably consistent. Dr. Kevin Stein, the CEO since 2017, he was COO before that, since 2014, has really just faithfully executed the strategic playbook laid down by the company's founders.
And he's retiring soon, right? Is that a risk?
He has planned retirement for the end of fiscal 2025, yes, but they've already announced a very thoughtful succession plan. Mike Listman, who's currently co-COO, is set to take over. It signals a deep commitment to continuity, not a sudden shift in strategy.
Okay, so the playbook continues. What is that core philosophy?
Dr. Stein often sums it up. They aim to own and operate proprietary aerospace businesses that have significant aftermarket content. The goal: to deliver private equity-like returns with the liquidity of a public market.
PE returns in a public company. Ambitious.
Very. It shows an explicitly long-term, owner-oriented mindset. And crucially, this isn't just talk. It's hardwired into how they govern the company, especially through executive compensation.
How so? What's unique there?
A huge chunk of management compensation is in equity awards, like stock options. But here's the kicker. These only vest in full if management achieves a 17.5% annualized growth in the company's intrinsic value.
17.5% growth in intrinsic value. That's a high bar. How do they even measure that?
It's defined pretty specifically, basically EBITDA multiplied by whatever the market multiple is, minus net debt. It's a calculation designed to reflect the true underlying value growth of the business per share. It perfectly aligns the executive's interests with long-term shareholders. They only get fully rewarded if they make the company genuinely more valuable over time at a very high rate.
That sounds incredibly well aligned. Okay, so that's the philosophy. How does it translate into actual capital allocation decisions? Where does the money go? Does it look like private equity owners deploying capital?
Absolutely. Their capital allocation follows a very clear, very disciplined hierarchy. It's textbook rational allocation.
What's the order?
First priority is reinvestment in their existing businesses. But for TransDigm, this usually requires pretty modest capital expenditure. It does include strategic R&D, though, aimed at developing the next generation of proprietary products to keep that pipeline full.
Okay, maintain the core. What's next?
Second, and this is the big one, the primary engine of value creation: acquisitions. M&A.
The flywheel.
The flywheel. They have an incredibly long and successful track record here, over 90 acquisitions since they were founded. The playbook is consistent. Target companies with sole source product lines usually pay around 9 to 12 times EBITDA.
Which seems reasonable for that kind of quality.
Right. They finance the deals with a mix of cash and, importantly, significant leverage. Then they move fast to implement value-based pricing, raising prices where appropriate, and drive cost improvements to boost margins.
And they're good at integrating these businesses.
Exceptionally good. The proof is in the pudding. They haven't recorded a single impairment charge or asset write-down on any of the 49-plus businesses they've acquired since their IPO. That's remarkable execution.
No kidding. Okay, so reinvestment, then M&A. What's the third priority?
Returning excess capital to shareholders. But again, they do it in a specific way. TransDigm doesn't pay a regular quarterly cash dividend.
No regular dividend. Interesting.
No. Instead, they do two things. One, opportunistic share repurchases. But they treat buybacks just like any other investment it has to meet the return hurdles. They don't just buy back stock automatically.
Rational.
Very rational. And two, they periodically pay out large special dividends. These are often funded with new debt. We saw a big one recently, actually a $75 per share special dividend in late 2024, financed by issuing about $3 billion in new debt.
Wow, borrowing money to pay a huge dividend. That's definitely a PE-style move.
It is. The whole approach screams rationality and shareholder friendliness. They are relentlessly focused on maximizing intrinsic value per share over the long term. You see analysts like Morningstar give them an exemplary stewardship rating. It reflects a culture that really tries to solve that classic principal agent problem, aligning management with owners.
And this framework, this disciplined allocation, that's clearly been key to their incredible returns.
Absolutely key. That's 16,000% plus returns since the IPO. It doesn't happen by accident. It's the result of this focused strategy executed consistently over decades.
Okay, strategy, management, allocation. Let's look under the hood now at the numbers themselves. Do the financials truly reflect this fortress business we've been describing? What does that picture look like?
Oh, absolutely. TransDigm is just a remarkably reliable earnings machine. It shows outstanding profitability consistently through all the ups and downs of the aerospace market, which can be pretty cyclical.
And the margins are key, right?
The margins are astounding for an industrial manufacturer. EBITDA margins are consistently the highest in the entire aerospace sector, frequently exceeding 50%.
50% EBITDA margins. That's software company territory almost.
It really is. In Q2 of fiscal 2025, for instance, it was 54.0%. It's a direct result of that pricing power we discussed. And it's what's fueled those 20% plus annualized revenue and EBITDA growth rates since '93.
Incredible. What about other key quality ratios? Return on invested capital.
Yeah, ROIC is consistently high, usually in the, say, 9% to 14% range over the last decade. And that's after accounting for the huge amounts of goodwill and intangible assets piled up on their balance sheet from all those acquisitions.
So even with all the M&A goodwill, they're still generating strong returns on the total capital invested.
Exactly. It shows that the M&A has been truly value creative, not just empire building. They're earning good returns on those acquired assets.
Then cash flow. Does it track earnings?
Even better, they're an exceptional cash generator. Free cash flow, FCF, consistently and significantly exceeds their reported net income.
Why is that? Accounting rules.
Yeah, basically. GAAP net income gets depressed by large non-cash amortization charges related to the intangible assets acquired in deals. So the actual cash pouring into the business is much higher than the bottom line net income number suggests.
Got it. So strong margins, high ROIC, massive free cash flow conversion. Sounds great. What about the balance sheet? You mentioned they use leverage for M&A and special dividends.
Right, and this is the one point that always requires careful consideration with TransDigm. By design, their balance sheet is highly leveraged.
How high?
They explicitly target a net debt to EBITDA ratio of somewhere between 5x and 7x. As of Q2 fiscal 25, it's stirred at 5.1x.
5 to 7 times EBITDA. That would be concerning for a lot of industrial companies.
It definitely would. But the argument for TransDigm is that it's manageable for them because of the nature of their cash flows, those highly predictable, recurring, high-margin aftermarket revenues.
So the stability of the cash flow supports the higher debt load.
That's the rationale. High leverage is a core feature of their model, used deliberately to amplify equity returns. But you can't ignore the fact that it undeniably reduces the margin of safety. It makes the company more vulnerable if something truly unexpected and catastrophic happens, a real black swan event.
We saw that leverage tick up during COVID, right?
It did. If you look back, say, fiscal 2024, revenue $7.9 billion, EBITDA $4.2 billion, that gives you the 52.6% margin. ROIC was 13.8%, and net debt EBITDA was around 5.6x. Go back to fiscal 2023, it was about 6.0x. During the peak pandemic disruption in 2020, it briefly touched 7.2x. So they manage it even through tough times, but it's always relatively high.
Okay, so a high-quality, high-margin, cash-gushing business, but with a deliberately leveraged balance sheet. Given all that, how is the market valuing TransDigm right now?
Well, unsurprisingly, it trades at pretty demanding valuation multiples. They certainly reflect the market's recognition of its quality.
What kind of numbers are we talking, roughly? Mid-2025?
Trailing price-to-earnings ratio is in the ballpark of 49x to 51x. And the price-to-free cash flow ratio is maybe 39x to 40x.
PE of 50, that's steep. How does that compare historically for them, or to peers?
It's definitely elevated compared to TransDigm's own longer-term history. Their 10-year average PE is closer to 44x, though it's actually below the recent 5-year average, which got distorted by COVID earnings dips. And yes, it consistently trades at a significant premium to the broader market and almost all its aerospace and defense peers.
Right.
You mentioned Honeywell earlier. Their PE might be around 27x, RTX Corp maybe 25x, TransDigm's at 51x.
Okay, so the market sees the quality and it's pricing it accordingly, maybe even pricing in perfection.
That's the crucial judgment you have to make as an investor. The current price is, without doubt, a demanding entry point. You're not getting a statistical bargain here. There's very little, if any, margin of safety based on the valuation alone.
So the investment case today really hinges on...
It hinges on your conviction. Your belief that this company's exceptional quality, its wide moat, and its high rate of compounding will continue unabated for many, many years into the future. You're essentially paying a full, fair price, maybe even a premium price, for what is undeniably a wonderful company, and betting that it will continue to be wonderful for a long time.
And what fuels that conviction about future growth? What are the engines that keep this thing compounding?
The single most important engine, looking ahead, is almost certainly the continuation of that disciplined M&A strategy.
Still more companies out there to buy.
Apparently so. The global aerospace components industry is still surprisingly fragmented. Lots of smaller, privately owned companies making niche, critical parts. So there seems to be a long runway for TransDigm to keep finding and acquiring these bolt-on moated businesses.
So M&A is primary. What about organic growth?
That complements the M&A. There are two reliable organic drivers. First, that secular increase in global air travel, we talked about the RPK growth, that directly fuels demand for their high-margin aftermarket parts.
More flying, more wear and tear.
Exactly. And second, their proven ability to implement consistent value-based price increases across their huge portfolio of proprietary products year after year. They have pricing power, and they use it.
Okay, M&A plus organic growth from travel and pricing. Makes sense. But no business is risk-free. What are the real, potentially permanent threats that could genuinely impair TransDigm's earning power? Things that could break the model?
Right. You always have to consider the downside. I think the most significant, plausible long-term threat is probably regulatory and political intervention.
Because of the price gouging accusation.
Exactly. Decades of scrutiny, especially regarding DoD pricing, create this persistent headline risk. You worry that eventually it could culminate in new legislation that fundamentally changes how they have to operate.
Like what kind of legislation?
Things like mandating cost-plus pricing instead of value-based pricing, or forcing them to provide much greater cost data transparency, or maybe even laws designed to weaken their sole source status on government contracts. Any of those could directly attack their pricing power, which is the heart of the model.
And you mentioned even big-name investors have criticized them.
Yeah, even someone as respected as the late Charlie Munger publicly called the business model immoral. That adds a layer of reputational pressure beyond just the financial aspects.
Okay, regulatory risk is number one. What else?
The other major one stems from that high leverage, a debt-fueled capital allocation error.
Meaning they mess up a big deal.
Precisely. The same leverage that magnifies returns on the way up could be a source of ruin if they make a major mistake. Imagine a huge overpriced acquisition that fails to integrate properly. Or maybe they line up financing for a transformative deal and then antitrust regulators block it after the debt is already locked in. That could be catastrophic.
And if that happened during an economic downturn?
That's the nightmare scenario. If their cash flows unexpectedly falter, maybe due to a severe global recession or another pandemic-like event at the same time that credit markets tighten up, making it hard to refinance, suddenly, that massive debt load, over $25 billion as of early 2025, could become an unserviceable burden.
So leverage cuts both ways. Any other big long-term risks?
The third one is probably more distant, but still worth considering: long-term technological disruption.
Like electric planes? Or something else?
Less about the propulsion, more about how parts are made. Think about additive manufacturing, 3D printing. Over the very long term, could that technology advance to the point where it significantly lowers the barriers to entry for producing complex, low-volume aerospace parts?
Making it easier for competitors to copy or create alternatives?
Potentially. If the major OEMs really invest heavily in scaling up 3D printing for certified parts, it could eventually change the economics of the aftermarket. It might become more viable for competitors or even the airlines themselves to reverse engineer and produce certain replacement parts, which would erode TransDigm's sole source advantage over time. Still seems far off, but it's a technological possibility.
Okay. Regulatory, debt M&A mistakes, and maybe long-term tech disruption. Got it. So we've laid out the bull case, the bear case. What's the general market consensus on TransDigm? Is our deep dive telling a radically different story or just adding color?
I'd say the prevailing market narrative is actually pretty accurate on the surface. The consensus view is that, yes, TransDigm is a uniquely high-quality, wide-moat business. Everyone acknowledges the brilliant, repeatable, private equity-style operating model. They see the enormous cash flow, the high returns on capital.
And the risks.
The consensus also correctly identifies that this quality is fully reflected, maybe more than fully reflected, in the premium valuation. And the key risks, especially the high leverage and the regulatory scrutiny, are very well known and widely discussed by analysts.
Which
generally leads most analysts to ratings like moderate buy or hold rather than a screaming strong buy. The market basically sees a wonderful company but thinks it's priced accordingly, maybe even richly, with known risks capping the immediate upside.
Okay, that makes sense. The market isn't blind to the quality or the risks. But digging deeper, as we've tried to do, where might the market be missing something? Or perhaps underestimating certain aspects? Is there a more contrarian angle here?
I think our analysis differs from the consensus less in identifying the key attributes and more in weighting their long-term significance and resilience. We might argue the market underestimates the sheer durability of this model, even in the face of those known risks.
How so? Take the political risk.
Right. The market sees the headline risk, the congressional hearings, but it might be underestimating the structural inertia that has protected TransDigm for decades. We talked about the insignificance of the cost of most individual parts relative to the whole aircraft or the cost of downtime.
And the pain is too diffuse idea.
Exactly. It's actually quite difficult to build sustained political momentum for a sweeping regulatory overhaul based on the price of thousands of different small components. It's not like a single huge visible ripoff. So the political risk might be persistent, but perhaps less likely to lead to truly transformative, moat-destroying action than the headlines suggest.
Interesting point. What else might be underestimated?
Maybe the cultural aspect. The market understands the PE model from looking at the numbers, the M&A, the leverage, the margins, but it might not fully appreciate how deeply ingrained that decentralized owner-operator culture is as a competitive advantage in itself.
The software running the hardware.
Yeah, that's a good way to put it. This culture empowers the managers at the business unit level, demands accountability, forces rational decision-making down through the organization. That's incredibly hard for larger, more bureaucratic competitors to replicate, even if they understand the financial strategy.
Okay, so the durability against political risk and the cultural advantage. What about the debt? The market definitely sees that as a risk.
It absolutely worries about the debt. But perhaps it underappreciates the strategic optionality that leverage provides to a proven rational capital allocator like TransDigm.
Optionality. How? Usually debt reduces options.
In normal times, maybe. But think about a severe industry downturn, when weaker competitors are struggling, maybe even facing bankruptcy, starved for capital. Who is likely to have the proven M&A playbook, the track record, and potentially still access to capital markets to swoop in and buy high-quality moated assets at bargain prices?
TransDigm, using their leverage model to get stronger when others are weak.
Potentially, yes. In a crisis, that debt, managed rationally, could actually allow them to significantly strengthen their competitive position for the next recovery cycle. The market focuses on the risk of debt in a downturn, but maybe underestimates the potential M&A opportunity it creates for a predator like TransDigm.
Okay, that's a compelling second-level thought. So let's try to bring it all together. To recap the bull case, the core reasons to be optimistic about TransDigm.
It really boils down to that near-monopolistic fortress, right? Built on IP, and especially that FAA certification wall. That gives them extraordinary pricing power and industry-leading profitability.
Plus the recurring aftermarket cash cow.
Driven by that long-term, non-cyclical growth in global air travel. It's a secular trend.
And it's run like a disciplined compounding machine.
Absolutely. Managed by leaders who are deeply aligned with shareholders, using a proven playbook that has shown incredible resilience and delivered just extraordinary long-term returns over 16,000% since the IPO. It's a quality argument.
Okay, but then the bear case provides that powerful counter-thesis.
Definitely. You have that constant looming regulatory threat, government intervention, driven by those price gouging concerns that could permanently hit their pricing power. That's probably risk number one.
Then the leverage.
Yep, the precarious leverage on the balance sheet. It creates significant financial risk, amplifying any potential mistakes, and leaves very little margin of safety if things go badly wrong.
And the valuation reflects the quality, offering little cushion.
Exactly. The demanding valuation means you're paying up, banking on continued excellence. There's no discount for the risks involved.
Plus the reliance on M&A for growth.
Right. Their high growth rate has been heavily fueled by acquisitions. Can they keep finding suitable targets at reasonable prices and integrate them successfully as they get bigger and bigger? That becomes harder over time.
Okay, clear bull, clear bear. So as a final thought for you, our listener, to chew on, imagine a scenario. What if those core assumptions, the ones underpinning the bull case, the impenetrable moat, the reliable cash flows, what if they simultaneously failed?
It's a scary thought experiment, but worth considering. Picture this perfect storm. Maybe a new populist administration comes in, really fueled by negative media reports about defense contracting. They managed to pass something like a Fair Defense Contracting Act that effectively voids sole source status for many contracts and mandates, full cost data transparency from companies like TransDigm.
Okay, so the regulatory risk hits hard.
Justice. Imagine a severe global recession hits, maybe worse than 2008. Air travel absolutely craters, crippling those commercial aftermarket cash flows that TransDigm relies on.
Oof, cash flow dries up.
And to complete the storm, maybe credit markets freeze up, just like they did briefly in '08 or during the early COVID panic. Suddenly, TransDigm can't refinance its massive $25+ billion debt load as it comes due.
Wow. Regulatory attack, cash flow collapse, credit freeze, all at once.
That's the kind of plausible, albeit low probability path by which an investment in this truly wonderful company, made at today's demanding prices, could turn into a major long-term mistake. The leverage would amplify the equity destruction massively.
It's a sobering thought, something to definitely mull over as you think about how even the very best businesses, the widest moats, still carry inherent risks, especially when combined with high leverage at a high starting valuation.
Absolutely. Food for thought.